Now, while there are a lot of details that tie into exactly how the real estate market is performing and which way it's moving, ultimately, how much people are paying for a house, there are still effects coming in as far as the minor economics that have effects on the home. And while we continuously strive to understand these, there are some macroeconomics that really haven't changed that much and that dictates our market. So stick around today as we let you know what's exactly happening. Spoiler alert, it's not going down yet. Hi, I'm Jake Tysiak, that guy that sells houses. I'm a realtor here in Illinois, and today we're going to be diving into the real estate market locally here in Chicagoland area, as it is different all across the country. Now, keep in mind, we will be covering sold price, of course, because people want to know which direction it's headed for the cost of their home or the value in their home. We'll also be looking at inventory levels and ultimately discussing how this is tying into our current situation and our future outlook, and how things like that might be changing, but really not too much. So stick around to the end because you'll want to pay attention to that. So let's start off as we usually do, talking about our sold price. Now, in the month of July, we did see our yearly average sold price rise about $1,100 to $363,489. Now, while this move is a more modest move than we've seen in the past 2 years, which is a good sign, showing that prices are starting to level off, you can see areas like DuPage County and Will County have both seen a little bit more aggressive moves still. And that is correlated with 12,175 sold homes in the month of July, which is down about 2,500. July usually being our second or third busiest month as we wind down towards the end of the year. Now, of course, we've also been tracking the new listings to make sure that we have new options coming for our buyers. And you can see that we had just over 18,500 new homes come on the market in the month of July, helping replenish some of those needs that we have from previous homes that have sold. Now, while new listings are important with inventory levels, a lot of people are really concerned, is there still people out there looking to purchase homes with these new elevated interest rates? And in the month of July, we did see 10,739 new homes go under contract, so still signaling that buyers are out there really looking for homes. So at the end of the day, our inventory levels are $26,224, a nice little raise from our June numbers. So when we do combine that and really look at how many months supply of inventory we have, the amount of homes that will sell based on how many homes they average, we've got about 2.2 months supply of homes here in the Chicagoland area. So that number is increasing, which is a good sign, but we're really still striving to get to that 3 to 4 months supply where we return to a little bit more of a balanced number. So as you can see, we are still seeing pretty heavily in a seller's market, even with interest rates increasing. And while there are many factors that really come into play with decisions with our market, there's really only a couple that ultimately affect our market. For one, we need buyers. We need people who are willing to buy a home, and we need sellers who are looking to sell their home. And on top of that, banks come into play as well. Now, most people are really concerned with interest rates and thinking that this is going to completely change our market. And it is true, interest rates have rose in the past few months, but we're still under 6% for most of the area. What I mean by that is 6% seems like a big jump from 3% just a few months ago, but when you look at it historically, there are still good rates out there. Being below 6 was not common until like 2004, 2005, where all of a sudden these great rates really started appearing. And if you go back even further, you saw interest rates in the teens in the 80s. So you can still see that although we are not at historical levels, which were only there because of an unprecedented pandemic that really messed up everything going on in our lives, and there are still people who are out there actively looking for homes. So what I mean by that is when we look at prices, people are always concerned about price being the biggest indication of how the market's going. Now, if we have equal amount of buyers and sellers, things stay pretty level and purchases go on as usual. However, when there are more buyers than there are sellers, we see what we've had the past 2 years. We saw rapid inflation in price, competitiveness that we've never really seen before, with people waiving appraisals and doing sorts of crazy things that just necessarily aren't smart for them, and created an accelerated market. Now, on top of that, of course, if we have more sellers than we do have buyers, obviously that's where we tie into that longer month supply. And that's really when we start to see prices either fall or level off. And this is exactly what happened after 2008 in the Great Recession. You see, there were way too many sellers and just not enough buyers. And a lot of that came into the fact that all these loans were made to these people who assumed that they could refinance or sell the property a few years down the road and make a win-win situation. However, at that time, all these sellers didn't have very many buyers. So they were forced to either sell, and most of them didn't really have any equity in the home. So instead of selling, was lost to foreclosure. Now, of course, those banks didn't want to hold on to all that inventory. So in the following years, you saw all that inventory return to the market. That's why you used to see years worth of supply of homes, not just months. So while currently we still have a good amount of sellers and buyers, and it's starting to level off. Again, we did have more buyers than we did sellers. But with this rate help reducing some of those buyers, you can see there's an equilibrium returning. Now, with that being said, obviously the amount of homes sold within a month will dictate how things move, how quickly they will move. While realtors, we love to see lots of sales because obviously it benefits us. The balance will help create a more predictable market. So with lots of buyers and sellers and lots of activity, you can expect prices to move fairly rapidly, or at least at a more accelerated rate than you will usually see in the housing market, around 4% per year. But if we start to see, which I predict we will, a little bit fewer sellers and buyers, but with equalness among them, that over the next couple of years, we will see perhaps a slight appreciation in prices, but just not necessarily that 4% as we start to taper off. Because even before 2000 or before 2020, our prices were still a little bit lower compared to the national average. And this is a big reason I caution you in where you get your news. What I mean by that is there are markets that have lots of fluctuation of ingoing and outgoing people. Here in the Chicagoland area, we stay pretty consistent. But areas like California, Arizona, even Idaho and Florida see lots of influx of people coming and going, and this is really what drives those crazy prices that you see jumping and going above offers, which are really, now that interest rates have changed, starting to suffer. So if you do live here in the Chicagoland area, I think we're going to see a more stable market and balance and better opportunities for everyone looking to buy or sell a home. And if you are thinking about buying or selling, feel free to give me a call. I'm Jake Tysiak with Keller. Thank you so much for watching. If you want to know more about buying a home, take a look up here. Otherwise, I will see you in the next one.